This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Thanks for joining us today on another edition of the Alternative Investing Advantage podcast. Today, we're very pleased to welcome on Pareto Technology CEO, who's going to be going through some very interesting aspects of cryptocurrency markets and how they work and interesting ways to invest with them. So please do stick around for that. Today on the download, we have two large regional banks losing a ton of value. PacWest Bancorp and Western Alliance Bancorp slumped more than 25% in morning tradings today, which is May 2nd of 2023, which is absolutely wild. This is pretty much hemmed on the tails of the larger bank failures that we've seen with people like Silicon Valley Bank collapsing a few months ago. So it's definitely showing some weaker things happening in the banking sector. The banking sector as a whole falling almost 10% on the week. So any one of those people that are out there that are investing in bank stocks or financial sector stocks, might be a good time to look at a repositioning strategy for you right now, because they're just getting absolutely hammered. Layoffs have risen to 2020 levels as the job market slides for the third straight month as the job market continues to cool. We're seeing people hiring less. We're seeing layoffs starting to increase. This is definitely kind of expected with the general market sentiment being a little bit less than it has been, coming up into this year. So definitely something to watch out for. Those of you that are out there looking at career changes or switching up what you're doing, the market is showing signs of cooling off and actually getting a little bit worse. So definitely some stuff that's interesting coming out of the Bureau of Labor Statistics. That was a report that was issued yesterday. And lastly, today on the download, Coinbase is launching kind of an interesting product that's in response to tightening U.S. regulations coming on the back end of the failure of FTX and all of the fraud issues with Sam Bankman-Fried at the helm of that company. They're launching an international derivatives exchange for foreign and institutional investors amid these increasing regulations. So these derivative contracts and these future contracts are going to be written against the pricing of Bitcoin and Ethereum. So definitely a little bit more on the complex side of things, but it's also showing what companies are doing, especially those that are based here in the U.S., that are going to be starting to see a little bit more scrutiny from U.S. regulators that are heavily involved in the cryptocurrency market. Thanks for listening. This has been The Download. Today on What is the American Depositary Receipt, an ADR? The term American Depositary Receipt, or ADR, refers to a negotiable certificate issued by a U.S. depository bank representing a specific number of shares, usually one share of a foreign company's stock. The ADR trades on the U.S. stock market as any U.S. share would. ADRs offer U.S. investors a way to purchase stock in an overseas company that would not otherwise be available. Foreign firms also benefit, as ADRs enable them to attract American investors and capital without the hassle and expense of listing on U.S. stock exchanges. This has been an American Depositary Receipt, and this is the What Is.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, I'm pleased to welcome on Junaid Ghuari with Pareto Technologies. We're going to be digging into cryptocurrency. I know it's kind of one of those things that makes the headlines a lot in recent months and over the past year, really, with a lot of good, a lot of bad, but trying to help navigate some of that and understand why this is an investment vehicle that people might want to pursue and also some different ways to do it. We're pleased to welcome you on. So thanks very much for being on with us, Junaid. Maybe tell us a little bit about yourself and how you kind of became involved in this, how Pareto Technologies got its start, and we'll kind of go from the conversation from there.
Absolutely. First of all, Alex, thanks for having me on. I'll just take it from the top here. So, I actually am a computational mathematician by training. I started off my career as a public sector climate scientist. So working for NASA, segued into the private sector as a data scientist. And actually, I was working as a principal data scientist at a analytics firm based out of DC, we were essentially providing strategic portfolio allocation decisions to a number of private equity and hedge fund partners at the time. I think it was around 2016 and then 17, starting to get a lot of clients that were very interested in crypto, particularly Bitcoin, and they wanted to understand how to allocate to the space, what feasible strategies would be, and so on and so forth. At the time, I thought it was, I was kind of surprised actually, because I've known about Bitcoin since the early days, but really I always viewed it from the lens of a retail investor, right? So I hadn't really looked at it from the standpoint of why would an institution want to be participating in the space. Essentially what happened at that time was, in the process of doing my own due diligence in the space, and not the sort of the traditional, looking at the decentralization, non-sovereignty, and so on, but really just doing a deep dive into the market structure, what kind of counterparties are in the space, what the overall infrastructure is that's built around crypto. I started to realize then, and I stand by it to this day, is that this industry really is changing, revolutionizing not just finance, but we're going to see a lot of other proximal industries that are impacted by this as well. So long story short, I launched Pareto Technologies, incorporated in 2019, and we started off as an arbitrage firm, largely seeking profits in the for spatial arbitrage opportunities, so pricing mismatches across different centralized exchanges. And since then, we've evolved quite a bit. We're an algo shop at this point now, and we essentially train machine learning algos to trade the markets for us and deploy a number of volatility strategies.
Yeah, no, that's you brought up kind of an interesting point, and I had an interesting conversation with my uncle, who's now retired, but was a large hedge fund manager for Citibank and also SunTrust, doing large institutional benefit plans, also in their high net worth individual stuff, and a lot of different things. And he had a very let's just say bearish outlook on when I brought up cryptocurrency when we were having lunch. To the point that, we weren't on just seeing different levels. We were in different cities of this thing. Not exactly someone who thought too highly of it, but, it kind of brings into scope of, him coming from the large institutional side of, you brought up, why institutions might be looking at this, because, until there is, I think, a lot of, more legislation and a little bit more regulation, the nature of this investment is going to be highly speculative. And, because you don't have a lot of regulation on it, it allows for things like arbitrage to be a very popular method of investing in this, because price point fluctuation is going to be, kind of a staple of the industry. Things are going to fluctuate very much, which creates arbitrage opportunities, which allows people to get into it. And typically you don't see a lot of the larger institutions wanting to get into something that has such a high volatility index. So, obviously they have, people like Fidelity, and I think Schwab and a few of the other big banks have now started, opening up the space for these things to be investments. Namely, the big news was, I want to say it was like Q3 of last year, Fidelity kind of launched it for their retirement plan, clients, which is what we do here at Advanta, in so far as allowing people to do that. And really the benefit for that is kind of the tax advantage of, you have these huge tax lots that are realized by these individual investors that can be an absolute nightmare to navigate. So I know I'm kind of rambling, but I enjoy this stuff. But let's kind of go back to why you think that the institutional side of things is getting involved, which I think one does good things to legitimize and kind of cement this as an investment vehicle, but also is kind of strange from the fact of how volatile it is, of why they're getting into it. So from a professional standpoint, why are the bigger players getting into it? Is it just people saying, hey, I want to buy Bitcoin, or is it something deeper rooted that we need to be looking at?
Yeah, so I guess I'd have like a multi-pronged answer to that. The first thing would have to do with just the volatility that you mentioned in general. I think what's interesting is that we're used to thinking of volatility in a very specific way within finance, and particularly within asset management. Bitcoin, no doubt, is extremely volatile. But if you look at Bitcoin as its price has been over the last 10, 12 years, year after year, it's outperformed any asset by a long shot. So, but if you were to look at its Sharpe ratio, especially within specific periods of time, it's pretty horrendous. So this actually calls into question how it is that we even classify risky or safe investment in the first place. The thing is that Bitcoin undergoes booms and busts on the regular, it seems now, unlike a lot of asset classes. And part of this has to do with innovation cycles, right? I mean, you have an order of magnitudes more people getting involved in the industry year after year, which contributes to the space growing itself. You have, at a protocol level, Bitcoin becoming more and more robust over time as well, with the recent introduction, of course, of the Lightning Network as well. So what this does is that, and now, of course, when you couple that with the fact that the human tendencies towards fear and greed are exorbitantly apparent in crypto. You end up having, that's what caused the booms and busts. So we can just take what happened recently into account with FTX and all of these other related parties that went bankrupt. Crypto was the space that happened in, but the problem fundamentally was not very different than what we saw happen with like Enron or with Lehman Brothers. So it was a very similar problem of over leverage, asset liability mismatches across balance sheets and so on. It just so happened that it was happening in a space that doesn't have a lot of regulation around it and can allow for some of these things like a market maker to also on an exchange happening at the same time. So to answer your question, I think there's the bearish view and the bullish view, of course. The bearish view, from your own standpoint, is that, right? It's that this is the Wild West. Why is it that this would be a safe investment? It's volatile and so on and so forth. The bullish view necessitates for somebody to be to redefine how they see risk. If your investment horizon is over longer periods of time, right, 5 years, 10 years, I would actually throw in my hat and say this is a very robust investment, right? And so yes, I mean, trading volatility and speculation is definitely how a lot of firms get involved. And honestly, our own strategies are mean reversion type of strategies. So they are trading market structure, but the goal for them is to accumulate Bitcoin, more for people who are actually looking to hold it as a long-term investment. So that's the why behind that. If you're able to redefine how you see vol, and your concerns not to, if you see like a 50-60% fluctuation in price to withdraw and then to exit the trade, ironically, this actually ends up being a fairly robust investment for very long-term investors like pension plans and endowments and so on, because over those periods of time, presumably, the asset should grow. It's very similar actually to you can almost think of it as like startup venture capital. It's no surprise that actually some of the largest LP bases are these same large scale investors. So I think it's going to take sort of a shift in how we see a risk around that. The same thing happened, and sorry to kind of go on about this, but the same happened with startups, in the early days, actually pre-dot-com bubble as well, where actually post-dot-com bubble, investors became more savvy in understanding how do you price risk for startups. The expectation is in the startup world that the majority of them will fail, but you're going to have a few unicorns that end up offsetting all of their losses and so on. So I think it's Bitcoin from a risk standpoint is kind of going through that now. The reason that this recent bust has made such a big splash, because I've been through a few of these cycles within Bitcoin, it's simply because there's an actual industry around it, right? There are actually like large sums of jobs that were lost in the process. That's why we heard about it, right? The spaces existed before, but it simply was just larger, and there were more institutions involved. So
yeah, absolutely. You brought up a few really good points that I want to kind of segue into. One, it is to the point that you made of seeing, looking at it as a future analysis. The only problem is that there is a lot of kind of presumptive math that has to be done on it, because 2008, is kind of the catalyst for all of this. So we can only go back 14 years of looking at this as a market and how it evolves. Granted, you can draw corollaries. I mean, to go back to the conversation I had with my uncle, I was trying to be like, well, you can kind of draw a good correlation between, Forex, you're kind of trading these different platforms to a point. I mean, it's, you're making a kind of a broad brush approach to that, but, with a slightly different air of, it being a true free market product, whereas you have, the ability of, Fed policies around the globe to influence, the monetary policy, which is going to drive up or down those costs. So you have, governmental regulations which affect that, but in the kind of the spirit of how this stuff works, again, it's free market adoption of a particular asset, in this case, a cryptocurrency versus another one. But something else that I kind of think is interesting to that, which I'd like to kind of get your pulse on, is you brought up the comparison to things like of the FTX and the Celsius and all these things in comparison to, let's call it, like the Madoffs or the Enron and things like that, where lack of oversight, I feel like, is part of the issue. I think FTX, if we had something like Sarbanes-Oxley, where you have, verified financials being signed off on by a CFO, some of these kind of like cross-leverage things where they're taking loans on the balance sheet of the coin that they produce, is kind of, things like that can be caught. Granted, it kind of goes antithetical to the nature of cryptocurrency, which I think is why people like it, the decentralization, lack of regulation being something that people like. So, kind of where's the happy medium? Because that's kind of a health issue of this industry. But it's also an understanding, FTX in general, if you were buying cryptocurrency on FTX, so long as you weren't, maybe investing in their token, but if you were following best practices, purchasing, trading, doing your trades, and at the end of the day, sweeping your holdings to, offline cold storage, not leaving stuff on an exchange, that could have mitigated a lot of the investor problems that we're seeing because of best practices not being followed. But again, people would like to think, if you're trading, if you're going to Fidelity, at the end of the day, you would like to think that you don't have to do like a sweep of your assets to not have an issue. So again, where do you kind of think that regulation in this market can help? But also, again, regulation cuts with a very dull axe. It's gonna try to solve the problem, but it's going to create other issues. So kind of where do you think maybe is a good direction of kind of happy medium of what you would like to see and maybe what you think is going to happen? Because there's several bills being kicked. I think there's one main one, but there's a few different people proposing edits in the House right now to some cryptocurrency legislation that we're probably going to see get voted on here in the next month.
Yeah, so a few things. I guess I can touch on the first few items you brought up and then answer that as well. So first of all, I think you asked about the parallels between foreign exchange. So here's the thing. Yes, this definitely has parallels with foreign exchange. I think, the difference here, which is actually the root of a lot of the arbitrage opportunities my own firm was seeking in the early days, has actually to do more with capital controls than price action. This space is, there's sort of like a different stratas of volatility. One of the stratas are entirely around it's based on its non-sovereignty. Capital controls mandate that there, for example, there's like the NBBO guideline, which mandates that any broker ends up routing to the best bid for US dollar denominated assets on exchanges. You can't have that in crypto, right? There's no way to enforce that. And on top of that, the majority of the space is quoted not only in stablecoin, but also the majority of the markets are quoted in Bitcoin itself, which is non-sovereign. So that's kind of that's how the market structure of it works from a foreign exchange standpoint. It creates a lot of obvious opportunities for asset managers, but at the same time, capital controls have to be imposed on the space through economic means rather than by regulatory means, by actually having more market makers involved and so on and so forth. So there's a real need and real value for market makers within crypto. You mentioned, I think after that, specifically the bit around what I would call endogenous collateral. So this concept of having an asset that a firm is issuing themselves, being the way that you're collateralizing a position or whatever it might be, or an investment. Yes, that along with a number of other issues are what are being explored now. These are issues, by the way, that endogenous collateral, it was very similar to what was happening with synthetic CDOs, back in right up until 2008. So it's similar to that. It's something that this is just sort of a different flavor of it now, where FTT token being issued by FTX Exchange, and then them collateralizing or them actually having basically an open book between them and Alameda Research, by way of FTT. These are the types of things that need to be explored. I will say endogenous collateral, some people may not agree here, but endogenous collateral is actually the premise by which the majority of fractional reserve banking systems work with in the first place. So, whatever that might mean in terms of our own banking system, but certainly I think that it's definitely making the traditional financial system have to look at itself through a mirror. And yeah, it's a bit of a character, a bit different, but it's bringing up some issues that actually exist within traditional banking as well. But yeah, I think ultimately the way that's going to be addressed in terms of the regulation part you're mentioning is situation by situation. I think the reality is that unlike many other industries, crypto is not something that you can easily regulate and control, and then also somehow maintain in your nation, in your sovereign state. It'll just move if it's prohibitive regulation. We've already seen that happen quite a bit for a number of different large crypto operations that went offshore. And so this is kind of the threat, I think, that exists specifically within crypto, which almost from like a game theory standpoint, regulators have to really think about that carefully. Is we can't just try to regulate by litigation basically, and just as things happen and say, oh, well, that was not okay, and therefore that's illegal now. But rather, being proactive about that is going to be the better way to go. Because let's face it, from a very straightforward economic standpoint, there's real tax revenue that this industry is generating, a lot of it, right? It's a fast growing space. That, if nothing else, is incentive enough for different countries to look into this. So now this actually came up in the House as well. Actually, they brought this specific point up. I do hope that they take that point seriously, because if not, I think while we could push a lot of crypto out, it will find a home somewhere else. And I kind of think we're seeing that happening now with, you may have seen recently, Hong Kong has been making quite a number of steps in that direction, where they're intending on, taking over that business. So
yeah, absolutely. And one thing that you kind of brought up with the tax revenue, one of the interesting things that I find about the whole, because the IRS, which I don't understand, it's a governmental organization based on generating revenue for the government, which would seem like they would try to, squeeze out dollars where they can, but yet there's no regulation against wash sales in cryptocurrency. So you have this huge amount of basically a loss factory that people can use to generate. Granted, it's not going to offset ordinary income. It's, basically a tool people can use for, capital gains and some other stuff. But that's a big one that, what I would think that is if, the revenue standpoint that they've obviously identified, they can make a lot of money on this stuff, which they did by changing the like-kind exchange update they had back in 2018 or 17, where they said that cryptocurrencies in and of themselves aren't like-kind enough to be, to be exempt from taxes. You treat it as a tax lot, profit loss from that standpoint. So they looked at it, but, I think that still didn't do a whole lot to quell velocity. But I think, and again, I don't actually know how much, and you could probably speak to this, how much, the lack of wash sale rules in cryptocurrency exists. Do you think that's going to help to slow velocity, which in turn would affect the markets and pricing to be less volatile? Or do you think it's kind of a moot point where they're probably going to get rid of it because it makes sense to get rid of it from a regulatory standpoint? It's not really going to have an effect. Because I was interviewing a gentleman, Micah Frame of Frame CPAs out of Tennessee, that specializes in cryptocurrency tax. And I didn't know that about wash sales. I just kind of assumed that was a thing across any asset class, but I was like, wow, that's pretty impressive that still exists. So to that specific point, again, for regulation, again, cutting with a dull axe, do you think that that or anything else is going to have the effect of slowing anything, or is this thing going to continue on its fast, albeit volatile trajectory that we've seen over the past 12 years?
Yeah, so look, I mean, in short, I don't. The reason for it is it goes back to the point I was making about business going offshore, right? The tricky thing with cryptocurrency is all of it. It's primarily, it's a financial product is how it's being viewed in most cases. Better yet, it's the way I would, an even more holistic way to look at that is it's a non-physical asset, right? So for that reason, it's just something that if so, WASH show regulations should be imposed. There's obvious benefits to that, but the challenge there is that there are vehicles that you can set up offshore, right, to bypass that altogether. And again, I go back to the point about the banking system and really the offshore banking system that also exists as well, is that this is making the the U.S. It's bringing sort of the U.S. dollar hegemonic system come into question, right? And how it's currently existed so far, and how it does allow for these types of things to happen on offshore jurisdictions as well. So ultimately, we end up having that the regulation has impacts on both traditional equities and what have you, along with crypto. So I do think that part of the conversation, part of the challenges around building appropriate regulation has to do with that. It's that in a way, it's like, yeah, we can't try to have our cake and eat it as well. Where if those rules are going to apply to crypto, that applies to equities, right? And so I think this is where some of the challenges are coming out now. Some of the bit that you mentioned about what's happening in the space now, really right now, the space is doing a little bit of growing up in the same way that I think, perhaps Wall Street had to attempt to do that as well in 2008, where we're realizing that it is possible for the dominoes to fall. It is possible for when everyone's drinking the Kool-Aid, at some point, somebody is left with a bag, and it could be the FTX, and it screws everyone over. So the reality is financial prudence is not something you can bypass, right? And you can't do that by way of endogenous collateral and so on and so forth. So I think that a lot of, and then also things like some of these centralized lenders that went bankrupt, right? Not having legitimate, and I don't want to say illegitimate per se, but it wasn't within what's legally sound. It's not having the appropriate broker or dealer's license or whatever the case might be. It was only a matter of time until these things would come back and bite us in the ass, so to speak. So I think that now the space has seen a mass de-risking happen by way of some of these counterparties that were really the sort of the horsemen for how some of these this over leverage is taking place. And as you can see, Bitcoin's still kicking, right? I mean, it's taken a serious hit, but it's made what's taken more of a hit has been the centralized companies in crypto, right? Some of these behemoths, the Celsiuses, the BlockFi's, the FTXs of the world. And Bitcoin's still alive, right? Crypto's still alive. So what this is now going to do is change the nature of these counterparties. Some of what you mentioned earlier might be put in practice, right? How is it that a centralized exchange should look? If they have lending practices, who should actually be responsible for that capital? In the case of a loss, right? Is this something that should be entirely insured by the exchange? Should there in fact be broker dealers, right? And how do you actually have those parties enter in the first place? All of these questions are going to now come into or these are going to find themselves in center stage now, I think. So yeah.
Yeah, and it also kind of brings up that point of the endogenous collateral being the issue that it is, and it's a great corollary to make of the fact that, well, how really different is that from the Fed, setting monetary policy on money they print. It's like they have this huge issue with it, but then again, it's like, oh, but just don't look over here, don't look at that.
Right.
But to kind of bring up another point also is that I think regulation, insofar as that, it's tough because if these things move offshore and the nice decentralized aspect of this, worldwide free market is that, part of this stuff, again, going back to like Enron and just, criminal negligence and on some parties, no, I'm not going to name names, but, violations of things is like terms of service, like, inherent, of just like burying stuff like ownership of assets on an exchange, like, turnover of custodial, like the custodial nature of this stuff. Again, how do you regulate that while also still keeping it, while still like enforcing those regulations? Because if something moves offshore, I can access a website anywhere in the world sitting right here. How do you regulate that guy that's, running a crypto exchange out of, the Maldives or the Bahamas? How do you have that kind of overreach, how do you have that reach without having overreach? I think it's a question that's going to be answered in time. And I think I could pick your brain. I love this kind of stuff. I could probably, continue to go on to that, but I think we've kind of covered, the state of the markets and what we're looking at and what might come into play. But, as far as the retail investor is concerned, looking at this from an outside lens, it's tough. It's tough to navigate unless you are someone like you with, a computational background and higher degrees in really complicated subject matters to identify this, or someone like me that deals with it professionally. Someone coming in, to kind of go back to the analogy of my uncle, someone that doesn't like this stuff or like cryptocurrency in general, how do you kind of navigate that? I think the point I'm maybe trying to get to are, what are kind of the salient points from an outside investor looking in saying, okay, what are kind of some of the things that I need to understand to be an informed investor to navigate this? Obviously, it's, Bitcoin gets the press. Okay, should I buy Bitcoin? Are the strategies, should I always look to realign my strategies? It's easy for me to say, from let's say a more traditional investor coming in saying, I want dividend stocks. I'm going to buy Coca-Cola and McDonald's and sit on it and get my 64 cent per share dividend every year until I die. You don't reevaluate that. It just sits there. But from this standpoint, I'm assuming that reevaluation should probably be something in the client's tool chest that should be looked at. So what are some of the kind of the tools if you were to, talk to a relative or someone and say, hey, here's the things that you just need to understand on par for cryptocurrency to be as safe as you can without, going into this head first. What are some like good points you professionally think people should understand?
Yeah, I mean, so a very the first and foremost one would simply be that I believe that every investment portfolio should have, and this one you probably heard before, at least one a very conservative investment portfolio would have at least 1% crypto. I would say higher than that, but some conservative amount of crypto. When I say now specifically with crypto, in my view, it would be Bitcoin and Ethereum. I'll go into those details in a second, and again, looking at it just from a portfolio theory standpoint, all else set aside, you could call this part of the riskier part of your portfolio, but you would be cutting yourself short to not do that. And now, if you really start to dig deep into this and gain more exposure to it, I would actually say this can go part of your long-term. This can be part of your long-term portfolio as well. Again, if your point's not to be looking at this on an intra-week or intra-month basis, even if it's year after year, that would still be a good way to go. We had investors that had actually subscribed to our own firm back when it was at 16 grand, right? Like, here's reality at that time. The asset rose quite a bit to like 65 or so on, but they're still happy with their investment, right? Because again, it was early enough that 25 is still good, right? So, but again, we're still looking at this from a standpoint of a year and a half, right? If they look at this 10 years down the line, it's a totally different animal, right? The people that invested back in 2010 and 11, they understand that because all of these values are irrelevant. These values are orders of magnitude above where they started off. So I think that would be the first thing, is that there's such an asymmetrical opportunity for financial growth. To not participate in some marginal way would really be cutting yourself short. That'd be the first thing. The second thing would be to understand, as I was mentioning at the beginning of our chat, was when we say volatility, what do we actually mean? So to really ask very fundamental questions about assets and investments in general, right? When we talk about intrinsic value, what is that really, right? I mean, I've heard this argument a lot, is that, well, it doesn't have intrinsic value. What intrinsic value does fiat have, right? Value is accrued from a consensus around, people essentially claiming that it does. If enough people believe in it, it has value, right? You can call it speculative, you can call it whatever you want, but the reality is that if there's no mode of exchange, if people are not agreeing on the fact that it has value, it won't. This could also be true for anything like gold as well. The reality is that the last however many thousands of years, it's we've chosen to give value to gold. We're seeing a shift happening now that's allowing this to happen with cryptocurrencies and digital money as well. So it's something that I would look at it from that standpoint. So yeah, volatility of the intrinsic value argument and so on. And the last thing that I would add is really sort of like a hedge against a sort of geopolitical capitulation, right? That's for better for worse, mostly not for better. We're seeing a lot of that happen these days, right? With Russia's invasion of Ukraine, with what's been happening between China and Taiwan, and so on and so forth. Really, what we found to be the case at our own firm is that there seems to be a very high correlation with these phenomena happening and there being positive impact in crypto. Well, why does this happen, right? If you look at this from like an on-ramp standpoint, much more capital flows into crypto in general, and not from like retail investors. This is from like large sovereign bodies when these types of things happen, right? When Russia had sanctions imposed on it by the U.S., not surprisingly, there was a lot of Russian dollars that found itself in crypto, right? So these are the things to kind of consider, is that it allows you to sort of step out of the commingled sovereign value stage that currently exists, and if you'd like to almost have a hedge against that sort of market capitulation, having crypto is all the more reason to or a better way to do that as well. So
yeah, and I really do try to explain that to people, is that people say, oh, well, it's super speculative or X, Y, and Z, and well, what happens if this happens? Well, I have to tell people, it's like, what happens if anything happens? No one, with the exception of, a few key players were really ringing the alarm bell like Dr. Burry was, before the crash of the economic markets in 2006 and 7. No one knows what the future is going to hold, but utilization and utility, I think, are the key points to look at. You talk about precious metals. Well, for years, people just liked it because it was shiny and it didn't tarnish. It made a really pretty headdress. Well, no one can tell that in today's society that'd be one of the, well, especially for silver, one of the best conductors of electricity, and especially in a hostile environment, doesn't oxidize. So now it's being used in everything from cell phones to satellites. So, you're going to find with anything, once there's enough adoption, you're going to find other modalities of use for it. It's going to happen. Once you have that kind of inflection point, which, again, people's like, well, when's that going to happen? No one knows that. It's impossible. It's like, well, it's like, when's the inflection point of, Tesla stock going, astronomically through the roof? When's it going to crash again? Oh, it's kind of happening, but no one essentially knows these things. So again, looking at it from the perspective of, we're already seeing one, it kind of started out with the, the white paper for Bitcoin being a decentralized currency. Great. It got adopted for that. But now we're seeing things like, again, the travesties that are happening in Ukraine. Well, if the government collapses, well, how do you exchange things across borders? There's not a bank opened up, but if you have an internet connection, you can go down to the grocery store and buy milk and eggs. There is a utility and a value to that. Granted, values fluctuate wildly, but you now have a, real use case scenarios of what this stuff can be used for, which I think is really important. And it just, it breaks my heart that, it breaks my heart that it has to be something like a sovereign nation getting invaded to really illustrate that. But that's the world we live in. That's kind of, what's showing it. It's not just people saying, oh, well, I can buy stuff and not have to worry about it getting exchanged through the BIC and SWIFT system to US dollars and back and going across the world. And it's simple. Yeah. But again, I think that's a really good point to make. So, kind of covering, the state of the market and what we're looking at, also kind of looking into, the things that people should really understand about this kind of stuff. You mentioned two cryptocurrencies specifically that you think are kind of, again, the stalwarts, and I think most people would agree, being Bitcoin and Ethereum. Bitcoin mainly for the fact that it was the first and has the most exposure and traction. Granted, there's issues with everything from, how comparatively slow its blockchain is compared to other things, how, I guess how anonymous it is compared to other things like, Monero or something. Granted, nothing's perfect, but then coming in and looking at Ethereum, again, I think people can kind of see why Bitcoin is kind of the leader in that. But I'd like to get your pulse on Ethereum because I have my own beliefs on why it is. One is because of everything, of all the kind of things it improved in its blockchain with things like smart contracts and just the kind of the general way it works. I'd like to get your opinion on why you think Ethereum, besides just the fact that it's popular and people have heard it in the news, of why it's a popular choice and really kind of one of the ones that would be the, top two of the, adoption stalwarts, that kind of thing of the industry.
Yeah, look, I mean, I'll give you a simple answer. And, when it comes to any investment or structuring a portfolio, I kind of like to look at everything from a game theory standpoint. And so, I'd love to give you like a dissertation on like why, from a technological standpoint, Ethereum would make a lot of sense. But the reality is, I look at it from, who are the different players in the game? What are their motivations, and what type of impact can they have on the overall structure of the game? So in other words, let's step away from crypto for a second. When before the Fed actually started issuing stimulus checks and started to intervene within some of the private market mass purchases of securities that it did to kind of keep the economy afloat early COVID, I was already kind of priming myself, trying to think about, well, what is it? Who are the players in this game? The major long, sort of the long player, the long put as they call it, is the Fed. The Fed has every reason to want the market to stay afloat. Now, it's not about where the market is, but the fact that it's actually, not hasn't failed, so to speak. Okay, so we know that. What type of leverage does the Fed have? Nationally, or internationally, a whole lot, an overwhelming amount by way of the US dollar, nationally, an infinite amount. Right. So when you look at it from that standpoint, you recognize the question, the problem framing in my mind becomes, okay, here's what I can say with a very high degree of confidence: the system's not going to fail. What I don't know is how that's going to happen. So deductively, where I have to arrive is the Fed's going to pull something out of its back pocket that's going to allow it to do that. It might be from a set of tools that we know of, or it might be from a set of tools that haven't yet been created, and they did just that, right? And just to name a few, they increased the debt ceiling and so on and so forth. That can happen, right? So that's the way I like to look at that. With that framework as well, and by the way, for investing, I think that, in my view, that always ends up kind of being the more, I believe anyway, more robust approach. You brought up the example of Dr. Ghuari. Rationally, if you remember, with Dr. Ghuari, he was absolutely on point with exactly what's going to happen. But the question again became a game theory question: was that how many people are going to act on that over what periods of time, and can the unfolding of the events as they're supposed to happen not happen based off of the leverage that some of those parties might have? Turns out that is true, right? The Fed, yet again, pulled something out of its back pocket, right? Bailouts weren't part of that equation. So, you almost can't look at this stuff deterministically. You have to look at it from who's involved, what's their leverage, what kind of pull do they have. From a Bitcoin Ethereum standpoint, sorry for that roundabout answer.
No, I'm all about it. I love those kind of long-winded answers that bring us back to the core of it.
Yeah, no, absolutely. So Bitcoin Ethereum, my view is this: I think in many ways, the Ethereum blockchain is a more robust blockchain from a scalability standpoint, and actually in some cases even a security standpoint, certainly from the standpoint of application. But that being said, just by the first mover advantage and the sheer inertia that the Bitcoin network has, I think I'm not very confident that it'll be surpassing Bitcoin in the near future. So when I look at my structuring a portfolio around this, I'm not looking at it from the standpoint of, well, how do the technicalities of the blockchain differ? It's rather, where is that inertia coming from? Which asset has a lot more like gravity around it, essentially, and it's overwhelmingly Bitcoin, right? Ethereum has changed. I mean, it's definitely relatively, like objectively, it's the number of active Ethereum wallets and the Ethereum market capitalization has increased relative to Bitcoin over the last few years, but it fluctuates, right? Bitcoin's in certain times actually continues to go the opposite direction as well. So the way I structure my portfolio is from that standpoint. And so it normally, actually in almost all cases, it's always comprised more of Bitcoin than Ethereum. Yeah, that's how I approach that. I hope that answers your question.
No, it definitely does. And I think that could be a whole other conversation on just the intricacies of it. Because you talk about people like utilization and, use the term gravity, which I think is a really good, aspect of it. The bigger something gets, the more mass it has, the more appeal it has, the more attraction it has to other objects near it. So again, I think that's really interesting. And I think it definitely got a big prop up from the huge rise of I just lost my train of thought. The huge rise in NFTs, the popularity of that being built on the backbone of Ethereum. Granted, I have my whole other issue with that that's a whole other conversation. But again, its utility was being utilized by another market, which again drives all these other eyes and helps to build it up, more adoption, and the like. So again, I think that's a very good analogy to kind of look at what are other factors in this besides just, okay, it went up, it went down. You have to kind of step back and look at it just like you do with any security. I don't think the principles change a whole heck of a lot. It's, if you're looking at a company that's doing exploratory drilling in, certain countries, it's like, all right, well, let's look at the news. Have they had are they on the verge of a coup? Well, maybe let's not, invest in a company that might get nationalized the next day. And again, those are extreme hyperbolic examples, but I like to try to, again, whenever I talk about something that's inherently very complex, and I'm sure coming from such an analytical background is, kind of putting it in real world examples for people of, there's not a whole paradigm you have to change with this. Due diligence is going to be due diligence, but what you look at might just change a little bit. You're not looking at, governments per se, but you're looking at, a specific industry, because everything is so decentralized. You don't have to worry about, again, a coup happening and the Bitcoin being nationalized. It's, okay, well, what other industries are doing this? Was it Venezuela that bought all the Bitcoin? Which South American country did that? Yeah. You have large adopters, you have, past institutional investors, you have countries, basing a lot of stuff on it. So looking at that kind of stuff, again, very, very, very big corollaries you can draw on this kind of thing. So, I think we've
actually, if I could just add one thing to that as well, is you actually brought up an interesting point about it not necessarily having to be seen from the lens of countries or sovereigns. I think it actually, the irony is that it can, right? Even though it's a non-sovereign asset, it's a very anti-fragile asset, right? And so countries that are well connected into the US dollar system, it's less beneficial for them, right? But for countries that are not part of that the SWIFT system, so to speak, for them it makes more sense, right? Because it's a better alternative than their current standing asset. So actually, what ends up happening is that even though directly it's not affiliated with a sovereign, it actually ends up improving due to sort of it could be like currency liquidity shortcomings in a country, or it could also be due to geopolitical distress. So the interesting thing is that it actually ends up being almost like a stochastic hedge against some of these events happening. And in that way, it's like it's anti-fragile, right? Is that when fragility manifests in countries in whatever form it might be, it allows that fragility to be addressed through financial means that the traditional financial system couldn't provide necessarily.
Yeah, and if anyone wants to get really angry, do a deep dive on how money is transferred between countries and the Fed Reserve System and the SWIFT system, on just how wacky that whole thing is. And sometimes it can be more efficient to get on a plane with a bag full of cash and go to another country to buy something. And my dad used to do a lot of business in Southeast Asia. That was a joke he made. He's like, it is so annoying when we're trying to negotiate something and you have to wait all this time. And then even if you have something like a big arbitrage event in a Forex, you could, eventually end up losing out just by how everything exchanges between it. It's like, if you're talking about large amounts of money that, a banking institution is not willing to eat, it's not $1,000 wire that they'll eat the spread on. It's, it starts to improve its utility from that non-centralized standard. And again, I'd love to pick your brain more on that, but I want to kind of, again, focus on, you as an individual investing in this, but Pareto Technologies, you mentioned, kind of getting their start and doing a lot of arbitrage in this. So give us a little bit of background on, you professionally in this space. Giving your thoughts is great, but professionally, identifying stuff, having those different, changes from being a climate scientist to this, how does that kind of get its traction, and how has it evolved, and what are you doing now with it?
Yeah, no, I mean, really, well, so, I guess from I guess the entrepreneur in me saw the opportunity, but really the mathematician in me saw the fact that, as I was mentioning earlier about the role of market makers and liquidity providers, I found quickly that there's a much more central role for some of these counterparties to play here, even more so than the traditional financial markets and capital markets and such. So that was kind of the transition point where I realized that that's a conversation I want to be part of, and here's a space that if you look at it dynamically over time, it's only growing, and it's, arguably actually starting to kind of like occupy the traditional financial space. But also the key players that are not just going to be in the space, but actually need to be in the space for its general health, are going to be, as I mentioned, people who are providing liquidity and so on. And then coupled to the fact that anyone can participate, right? Like you can have people from countries that would never have access to a broker be able to get onto a crypto exchange and so on. That backdrop helped me sort of inform for me that's what allowed me to realize the fact that this is a space that I can get involved in with the skill set that I have. And so really it was a lot of this like stochastic programming and modeling that I ended up using in crypto that I actually used to use for oceanic and climate modeling as well. So, and then the objective there was more around predictability around, like large scale events happening. And here it has more to do with the improvement of alpha for our portfolio. So nearly same skills, just different application.
Great. So tell us a little bit about how y'all function. Is it more of kind of like a cryptocurrency hedge fund? Is it individuals placed on like a trading platform? Give me the rundown of, because there's a bunch of different flavors of cryptocurrency investment firms. It's just like there's a lot of different flavors of cryptocurrency. So give us a little bit of a rundown of what y'all do and why you think it's, a good, prudent decision.
Yeah, no, absolutely. So for us, we actually manage money on behalf of high net worth individuals and accredited investors, and then also institutions, ranging from like fund of funds, multi-strategy managers to family offices and such. And then, long story short, we basically run everything by way of managed accounts. So essentially, every individual or institution has their own managed account. And our system essentially systematically trades on those accounts individually. So it works really well because it's held individually by the organization or person. It's not commingled, and then on top of that, we largely been actually advising IRA clients, or the capital IRA clients. We found that there's a large body of individuals who have IRAs that have accumulated wealth over the years, and really they're seeing that their IRAs not performing as well as they were hoping. Right, the traditional market's not doing great, so that's capital that they would actually like to allocate elsewhere. So we've been able to provide that service for IRA investors, is to give them that alternative where a lot of these investors, they want to gain access to crypto, but they're a little bit concerned because they're not looking at this market 24/7 like we are, and so we end up being the sort of the natural partner for them.
And I think that's a cool point that you bring up, is that I've professionally at Advanta, I've seen, call it, the private hedge funds, the limited partnerships that kind of have more of like a pooled asset approach to this, where it's, okay, everything's commingled, we invest the fund, pay out a return on a K1. But the managed account aspect is not something I've really seen from that. I mean, you can have a managed account with a broker at Fidelity or something, but your exposure to crypto is going to be very narrow if that broker wants to do it at all, because ultimately broker discretion, I think a lot of them, unless they're younger or just savvy and like math, aren't going to really be, deciding to have that as an asset allocation. And even if they do, they're not going to be able to have the exposure on their platform to really kind of get past maybe just Bitcoin and Ethereum. So, it's really interesting to see that. It's kind of the first one I've seen of taking the approach of a true kind of cryptocurrency approach on a managed account level. So, I think that's pretty interesting on the fact that you do that, and also bringing up the aspect in the point of IRAs, to give a shameless plug of the benefit of doing this through a retirement plan. I mentioned, in 2017, they got rid of like-kind exchanges and the issues that people have with, if you're going out and trading this stuff and, quote, day trading it, you could have a real issue at the end of the year with the volatility of this stuff, to the point where, like, if you sell, you might have a tax bill that you cannot pay with the cryptocurrency holdings that you have. So doing it where you have the ability to do it in a tax shelter and the ability to kind of, once remove yourself and have the experts do it in a managed account vehicle, I think definitely has some benefit there. With that said, we're kind of getting up. Go ahead.
Sorry, just a quick note on what you just mentioned there. The only thing, and that's actually just to add to your point there, with the Fidelity example or the traditional IRA example you're giving, that's exactly the case. I mean, in most cases, you're going to have passive exposure to crypto assets, and a lot of people aren't going to be happy with that because of just buying Bitcoin on your behalf and just seeing it go 7 different directions. Whereas for us, we actually have a systematic and actively managed strategy. So one of them is a US dollar based absolute return strategy. The other one's a BTC accumulation strategy. And so that's a much more of a unique type of exposure to the space, where it's not just about it being bought and held there, but actually it being traded by our software we've developed to accumulate a return.
Awesome. Great. Well, Junaid, I really do appreciate you being on today. I know you, like everyone else, is incredibly busy, and your time is your most valuable and irreplaceable asset. So thank you very much for being on with us today. If they'd like to get in touch with you, where do you have a website, direct email, phone number? Where can they get more information about Pareto Technologies?
Yeah, absolutely. So you can always go to our website, paretotechnologies.com. That's Pareto technologies in the plural.com. And you can always feel free to email me, Junaid, Junaid, at paretotechnologies.com. I can be, sort of a large inflow of emails from service providers and so on coming in as well. So, you can also CC our head of business development, Andre, which is ANDRE, at paretotechnologies.com to the email as well. And he'll be in touch.
All right, great. Well, thank you very much for being with us today. I appreciate everyone that tuned in to this edition of the Alternative Investing Advantage podcast. Thanks, and have a great day.
Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.